Hi everybody, welcome back to the Dean's Institute. Today we are going to learn some of the important basic accounting terminology. This is a new series we have started in order to understand accounts like a pro. Okay, without further ado, let's get started. So, now, okay, let's first understand what a capital is. Capital is the amount invested or put in his own business by the owner. So the concepts that you need to pay attention to is it is the amount, okay, it is the amount invested in business by the owner. It has to be his own business. This word his business or her business is very important. If a person is investing in somebody else's business, that's called investment, not capital. So the concept over here is it has to be amount invested in his business by the owner is called capital. As you can see the images here, so it's like investing into the business. Alright, let's go to the next one. So what's drawings? Drawings is the opposite of investment. So in investment, the owner is putting the money into the business. Here he is withdrawing the money. Okay, he is removing the money, but it has to be for personal use, not for business use. If it is for business use, then it will be part of the expenses. But if he is using for his daughter's education, or he's going and buying, doing some shopping, or he's going for a family trip, things like that, or he's buying his car, which is not a business car, it's a personal car, all these things fall under drawings. Okay, so another thing you need to understand is capital increases the amount the owner has in the company, and drawing reduces the amount he has invested in the company. Because for example, he's invested 1 lakh rupees, so the company has to pay back the owner 1 lakh. But for example, he did a drawings of 10,000. Now the company is liable to pay only 90,000, not 1 lakh. Now the owner has got only 90,000 in the company. Okay, let's move on. Now let's understand what income is. Income is if the company sells any services or products, and in return get money, that is called income. They have to sell services or products or both in exchange to money, that is called income. Like for example, here the doctor, his consultation fees, his knowledge is what he is providing. He's providing a service, his advice, medical advice. He's not selling any product. Whereas here this lady is selling the tie, which is a physical product. But if you take the case of a like Geo, they sell hotspots, MiFis, they sell mobile phones. That's a product, physical product, and they provide uh, data, they provide calling services. That is a service. So a company can do both, or can just provide service or products. It's still considered as income. Now, the opposite of that is an expense. If the company buys something, it could be a product or a service, and pays money in return, that is called an expense. If a company buys a product or a service and pays money It's called expense. All right. Now, now let's see what sundry debtors are. Sundry debtors are credit customers, customers who buy or to whom we sell on credit. If it is cash customer, they don't fall under sundry debtors. Sundry debtors are those customers who need to pay us for the goods they have bought from us. Okay? Opposite of that is sundry creditors. So sundry creditors are from whom we buy on credit. Here to whom we sell on credit, and here from whom we buy on credit. Basically his supplier. In other words, here we call them customers, here we call them suppliers. But here we are buying on credit. Like we are buying today and we'll say we'll pay later, maybe tomorrow, 1 month later, whatever the payment terms and conditions are. So they become our sundry creditors. Okay. Now, anytime anything in business is valued in terms of money, if the value increases, it's called appreciation. Normally, we see houses and land and property, that value goes up. Oh, my dad bought it for 10 lakh rupees, now it is 50 lakh rupees. So the value has gone up. If the market value of any product, it could be tangible or it could be intangible. Tangible means something you can touch, like a building, as you can see over here, or you have a very old two-wheeler or car which has become vintage, that also appreciates, market value appreciates. So that also is appreciation. uh, like for example, a new brand comes in the market and then the brand becomes popular, so the brand value increases. So that is intangible, you can't see a brand. Okay, so you can't touch a brand. I'm sorry, you can't touch a brand. So it's intangible, like goodwill of a company. Goodwill is how much money people are willing to pay to get that business. Okay, if that business is doing very good business, like for example, you may have a sweet shop near your house. So initially um, he was willing to sell the business for 5 lakh rupees. Now the business is doing, after 2 years the business is doing very well. Now he will not sell that for 5 lakhs. He will ask 25 lakhs. He'll say that I'm giving you a running business. So the goodwill has gone up. So that is appreciation. The opposite of that is depreciation. When the market value of any product crashes down or goes down, that is called depreciation. I have just used a car which is damaged, just to show that it is damaging the value of the product. Not necessarily, even if you buy a brand new car and bring and keep it at your home, the next day if you try to sell that, you will not get the same value. The value drops, the market value drops. So whenever the market value of any product or service it drops, that is called depreciation. Now let's look what an asset is. An asset is basically cash or money, money value in the form of a building, a motor car, goods in hand, bills receivable, various other assets are there. So just you need to remember is cash that you can receive in future. Sometimes you may have liquid cash, this is ready cash in your hand, and cash in your bank, for which you need to go to an ATM or you need to go to the branch to get the physical cash. If you have a building, that will take time for you to sell and get physical cash. So anything you own which can get you money, that is an asset. It could be a current asset or a fixed asset. In the next video, we'll look what more deeply what are current assets and fixed assets. But as of now, just understand any product or cash in any form which is there, which you own, you have to own it. Your neighbors may have got a property, but that's not an asset for you. So you must own it. So for which you can get money. Either it is readily available in cash form or it is in the form of a building, motor car, or any other form. Goodwill is also an asset. Copyright is also an asset. So assets also are tangible, intangible. That we can look at a later point of time. Now the opposite of that is a liability. Liability is actually your obligation. You must pay now or in future. It could be a personal loan, business loan, car loan, home loan, any form of, it could be credit card purchase, anything which you owe other people and you have to pay them back, that falls under liability. Liabilities also, current liabilities are there, uh, uh, long term liabilities are there. So various types of liabilities are there that we look at a later point of time. So let's quickly do a recap of what all we did. So we learned 8 concepts today. Capital is the money owner puts in his business. Okay. Drawings is the money he withdraws or removes for his personal use from the business. Now, income is when you sell any service or product or both and get money for it, that's called income. If you buy any product or service by paying money is called expense. Now, sundry debtors are your credit customers who buy from you and will pay later. So they are sundry debtors. Sundry creditors are to from whom you buy on credit. You're buying it today, maybe in the evening or tomorrow or week later, month later, whatever, you have to pay them back. So they are your suppliers. Suppliers who give you on credit, they are sundry creditors. So for example, there might be a credit supplier who does not give you any credit. So he's not a creditor. So those suppliers who give you products or services and ask you to pay, give you the chance to pay later or ask you to pay later, they are sundry creditors. Appreciation is increase in value of any tangible, intangible product that you own, product or service that you own is appreciation. Depreciation is the decrease in the market value of the product, which is called depreciation. Now, an asset is money that you can receive in future of the by owning some products, some physical or non-physical products that you own. In asset also you must own it, otherwise it's not an asset. Okay, so it could be in liquid or illiquid form. And liability is your obligation or your duty to pay back, maybe immediately or maybe later, to others. That means money which you have taken or products you might have taken. Now, sundry creditors is also liability. Okay, so in this case, sundry debtor is an asset because they need to pay you back. So in sundry creditors, bills payable, all these things, like you have not paid the electricity bill, that's a bills payable. You have not paid salaries, that's outstanding salaries. That's also a liability. So there are various things. And the money you own, the company owes to the owner, which has to pay back to the owner. That is also a liability. With this, we come to the end of this session. Thank you for joining us. If you've not subscribed to our channel, please go ahead and subscribe, press the bell icon, and also leave your valuable comments. Let us know how did you find this video. If any shortcomings, please do let us know. Also, do give us an information of what type of videos you're looking forward so we can make it for you. Thanks for tuning in. As of now, Ayub here signing off from the Dean's Institute. Bye.